The markets might seem overvalued right now, and plenty of people are calling for a major correction. But investors don't usually make mistakes because of lack of information. They make mistakes because they don't have the information that matters the most. In the next few minutes, I'm going to go over 14 of the most critical charts that every investor should know. And once you see these, you will never look at the market the same again. So let's get started. Okay, this first one I want to go over is giving you an example of how much the markets have changed over the last few years. What this is showing is the percent weight by cap in the S&P 500 of just the 5 largest companies. Notice going back to 1990, usually the top 5 companies made up somewhere between 7 and 15% of the overall S&P 500. Currently, they make up almost 27% of the S&P 500, just 5 largest companies. Okay, so in the Wall Street Journal just reported recently that the total S&P 500 earnings are on track to rise 27% in just the first quarter. We don't know the exact number because all the companies have not reported earnings yet. But while the Mag 7 profits are expected to jump 61%, the other 493 companies are projected to just grow by 16%. Okay, so the overall S&P 500 is changing very much in the last few years. Now, the capital expenditures of just the 5 largest hyperscalers, which are the companies that are building out the cloud and AI infrastructure, okay? Just a year ago, back last June, they were projected to spend $365 billion. But just less than a year from then, okay, so in May of this year, now they're projected to spend $727 billion. So that's larger than the GDP of some of the mid-sized European countries. And these companies are massive. It's hard to describe how large they really are. Take NVIDIA, the largest company currently in the world right now. It's roughly about the size of the total GDP of Germany, which is the 3rd largest GDP in the world. If we take NVIDIA and the next largest currently, Google, those 2 companies together dwarf every other company's GDP other than US and China. Okay, so the market has changed very much in the last few years. But if we think of that's leading to increased volatility, let's just look at the last 8 to 9 years. If we go back to 2018, okay, we had rising rates. The market dropped about 10%. In 2019, the Fed kind of tightened policies. We had some tariff fears. The market dropped about 20%. In 2020, we had the pandemic. The market dropped 34% in a 4-week period. Okay, then we had 22 and 23, very high inflation rates. The Fed hiked rates, and then we had the Russian-Ukraine war break out. Okay, so the market dropped quite a bit. Then last year, we just had the tariff tantrum. The market dropped, okay, about 18%. This year, we had the Middle East conflict. The market dropped again. Okay, so we have a lot of volatility. Volatility is nothing new when we talk about the market. However, let's look at the historical returns of the S&P 500, including its dividends. In the last 5 years, 14.45%. Last 10, 14.86%. Last 15, 14.08%. Last 30, 8.81%. Notice the 30 years even included the dot-com bubble, the first few years of the 2000s, which we had 3 negative years in a row, and the housing crisis. And then the last 40 years, 10.36%. So even with all that volatility, the market just keeps chugging along. Okay, but when investors look at how investments grow over time, we usually see some kind of graph that looks like this. Now, this is a graph of a very modest 8% rate of return. Okay, this is a graph of starting out with $100,000 and then investing $6,000 per year, every year at the end of the year. And over a 30-year period, it would grow to about $1.7 million. So people show these kind of graphs all the time. It looks like a nice smooth curve, but this is never what investors experience. This is what you experience: a volatile market. This is all the years going back to 1872. Okay. The green bars are, of course, the years where the market was up. The red is years where it was down. Okay. Some years are good, some years are negative. And over time, we saw those, 10, 15, 30, and 40-year returns of the S&P 500. Very, very good. But this is what we experience. We never experience steady growth like this. Okay, so stocks rise, volatility is normal. The blue dots here represent the largest pullback anytime during that particular year. And the dark blue bars here represent where the market ended up that year. Notice here, in 2020, during the year, the market dropped 34%, but yet it ended up 16% that year, okay? Here it was down 34%, okay? And it ended up minus 23%. That was kind of a bad year. But you can see the volatility that happens, okay? Notice these years. We had lots of pullbacks during those years, and those were positive years. So lots of things happened during the year too, okay? Now, however, most years are good. This is looking at the last 40 years of the S&P 500. We look at the S&P 500 because that's usually used to represent the overall market. Now, the green boxes, of course, are years it was positive. Okay, this is going back to 1985. There has only been 8 negative years since 1985. Most years are up, but we do experience some negative years. Some of these are mild, like a minus 3.1%. Some of them are larger, like when we had the housing crisis, minus 37% in 2008. But most years are good, but you should expect some negative years. That is common. Now, let's look at bull and bear cycles. Now, first of all, a market correction is usually defined to be anything more than 10% but less than 20% pullback. Anything over 20% is usually defined as a bear market. Now, so the red bars represent the bear markets and the blue represent the bull markets. The size represents the cumulative gain or loss during that period. Okay, go back to 1973. The bear market lasted 21 months. It had a cumulative pullback of 48%. Okay, during the housing crisis, it lasted 17 months, had a cumulative pullback of 57%. But look what happens after a bear market. Massive bull runs usually, okay? After the housing crisis, we had a bull market that lasted 133 months, and the cumulative return was 401%. Okay? You can see this massive run here, 582%, lasted for 150 months. Now, on average, if we take the average of all this is going back to 1960, the bull market average duration, bull market, is 64 months. The average bear market lasts about 14 months. The average total return during a bull market run is about 185%, and during a bear market, it's down about 36%. Now, those are just averages. We can kind of see what actually happened here. But notice, regardless of what happens, okay, we have that volatility, but the market does recover and continues to go up as you go left to right. So we need to expect volatility. That is part of investing. Now, what should we do during a bear market? We already saw that the market always recovers, okay? It may take 1 month, like in 2020, okay, the market dropped 34% in 4 weeks, recovered very quickly. But it can also last longer, okay, like it did during the housing crisis. But it does bounce back. So the key thing is to try and stay invested so you don't sell at a loss, but you should keep investing through dollar cost averaging. What we're going to take a look at here is we're going to start out, let's say you're buying some fund for $50 a share, and you're going to invest $1,200 a month, and we're going to have a 50% pullback all the way down to 25. This bear market will last 10 months. Now, when it drops to 40 at $1,200 per month, you could buy 30 shares. In the second month, okay, if it drops to 30, you could buy 40 shares. If it drops to 25, now a 50% pullback. Most people would probably panic, sell, or stop investing altogether. But notice there, you could buy 48 shares at that price. Then maybe it goes back up, you buy 40, and then it drops back down, you buy 48. And after 10 months, it eventually gets back to where it was. The market recovers. But you kept investing. Now, during that time that you were investing, okay, $1,200 a month for 10 months, that's $12,000 invested. But if you add up these shares, there's 370. And at $50 a share, they're worth $18,500. You invested $12,000, and just the investment over this 10-month bear market is worth $18,500. That's a 54% return on just the investment you made during the bear market. So when we have a bear market, if we can control our emotions and write it out and keep investing, stick to our plan, keep investing, that gives you an opportunity to really buy when the market is on sale for a while. And in the long run, it's going to help you. We saw what the market does over, 10, 15, 20, 30, 40-year periods. Okay. If you continue to purchase and invest during really volatile pullbacks, okay, it actually helps you. Okay, now, what you don't want to do is think that you can jump out and know when you can jump back in. Because usually the biggest returns, the days that have the biggest returns, are really after really bad days or a bad period. Okay, so this is the actual returns from 2006 to 2025 at the S&P 500. 11% annualized return. Notice that does include the housing crisis. Now, if somebody stayed fully invested, the average annualized return over that period of time is 11%, but missing just the top best 10 days, excluding the top 10 days, the average return would drop to 6.6%. If you miss the top 20 days, 3.8%. Miss the top 30 days, 1.6%. Okay, so we can't think that we can time the market. We'll jump out and then know when to jump back in when the volatility is over. You're going to miss a lot of the best days that happen. So, and usually people sell when the market's going down, so they're selling at a loss. Then they're kind of fearful to get back in, and they miss the biggest days when it starts bouncing back up. So it's usually better to just stay invested and then keep investing through those down periods. Okay, now, I know a lot of people are always concerned about who's in the White House or who's in control of Congress, but regardless of politics, okay, this is going back again to 1960, okay, whether it's red for Republican or blue for Democrats, notice the market does generally just go up left to right. Our economy in the US is very, very resilient, regardless of what is happening. Okay, now, this is kind of a crazy example. Let's say somebody is going to invest $10,000 per year for 20 years. Okay, this is going from 2004 to 2024. And this is actual data now. If somebody was able to pick the absolutely best day during every one of those years to invest their $10,000, in other words, they invested the full $10,000 at the lowest point, the exact best day that they could have bought. Okay, that's the green chart. The other person is the unfortunate one that bought on the absolute worst day possible throughout the entire year. He invested the full $10,000 on the absolutely worst day possible when the market was at its high during that year. Now, if they did that for 20 years, every day, the one investor bought on the perfect day every year, and the other investor bought at the absolute worst day during the year. The person that bought on the worst day of every one of those years still averaged 10.54%. The person that bought at the very best day of every year averaged 12.25%. Now that is significant. It's about 1.7% greater gain per year. However, nobody's going to buy on the best day or the worst day every single year for 20 years. Okay, so this is just an example that we shouldn't really worry about trying to time the market or whatever. We want to just be consistent and dollar cost average every single month and keep investing whether the market is going down or up. Okay, multiple studies show that over the past decade, equity investors, people that are investing in just all stocks, usually do about 3% worse than the overall market because of emotional decisions. People that invest in asset allocations, like trying to a 60-40 or diversify a little bit more, they tend to average about 4% less than the typical 60-40 portfolio. Okay, again, we need to stop making emotional decisions when volatility happens. Okay, so now this is another thing I wanted to go over. Okay, a lot of times, we think, well, we'll just pay somebody else to do this. This comes out twice a year from the SPIVA report. What this is showing is how well actively managed funds do against just the their S&P benchmark. So if we look at all U.S. domestic funds compared to just the U.S. composite 1500 here, last year, 79.83% of actively managed funds did worse than their benchmark. Now, what's crazy, if we look at large cap growth funds, actively managed large cap growth funds, 95.51% of them last year did worse than just the S&P 500 growth index. Okay, so again, you can buy an ETF that follows the index free without paying a manager. So if we take a look at how those active managers did after their fees are subtracted, very few do better. In fact, if we go out like a 10-year average, you can see, somewhere between 85 and 90% of most actively managed professional funds do worse than their benchmark. And if we go 15 and 20-year period, basically on average, about 90 to 95% of them do worse. So if you're using actively managed funds over the long run, you have about a 90% probability of just doing worse than if you would have just bought a simple passively managed index fund similar. Now, if you want small cap, well, you can buy the SP 500 small caps 600 ETF, rather than having an actively managed fund. Now you got to be careful. Actively managed funds are, they're aware that people are finding out about this. So, of course, more people are looking for ETFs, assuming that they are passively managed. But actively managed ETFs now account for roughly 80% of new ETF launches this year and have attracted $459 billion in net inflows in 2025 alone. So what they're doing is, now people are moving away from mutual funds, so now they're just having an actively managed ETF. But regardless, they don't do well against just the ordinary benchmark. So there's very little reason to be paying a manager a bunch of fees when you could just buy a simple ETF. There's one that exists for pretty much anything you'd want to invest in. And over the long run, you'll do better than 80 or 90% of professionals. Okay, so what's the big takeaway here? Well, investing, it's really the only field where the ability to do nothing can be a competitive advantage. There's no need to react to the recent news that we hear every day or every week, okay? You want to stay invested and stick with your plan because we all suffer from recency bias, which is the tendency to place greater importance on recent events than long-term historical trends. And I hope these graphs help you understand what we should expect and what the long trend terms are. Volatility is normal. Okay, history shows that investors may improve their odds by achieving stronger long-term returns by remaining disciplined, staying invested, and following a simple plan. One of the biggest threats to long-term investing success is human behavior, not market volatility. Emotional decision-making can undermine returns when investors overreact to normal market movements. And I hope these graphs and charts that we looked at today help you understand that even when we have a lot of volatility, that is rather normal. Don't speculate. The stock market may attract people looking to get rich quickly, but it rewards patience and discipline. Investing requires temperament far more than it does intellect. Okay, so I hope some of this information today has been helpful. If it has, please hit the like button. Leave me some comments below of what you think of some of this information. Thanks for watching.